Well, Treasury yields are yet again on the rise today as investors weigh an uncertain economic outlook. The markets are looking for any diplomatic update amid rising tension in the Middle East. The fear of wider spread conflict around the outbreak of the Israel-Hamas war has driven up oil in recent days. Prices are currently ticking down this morning, though. But as we head into a busy week of earnings, is there an upside for the markets? Well, joining me now is John Lynch, Comerica Wealth Management CIO. Thank you so much for joining me this morning. So obviously investors had a lot to contemplate over this past weekend, especially with that backdrop of the conflict, plus this bumper week of earnings that we came off of for the banks and coming into this week. What are you watching in terms of market sentiment this week?
Well, thank you, Rochelle, and good morning. Yeah, investors obviously woke up in a good mood. I'm not sure I figure out the morning trade thus far, with 10 years yield up about 10 basis points and the equity market up about 1%. So this week, it's all going to be about earnings. I think it's going to be, to a degree, clarity. If there's any diplomatic hope for a diplomatic resolution to the Israel-Hamas war, I think that's unlikely, but any positive signs, I think, would be refreshing, and to the degree that investors can just get that balance between market interest rates and earnings. This could conceivably be the fourth consecutive quarter of the earnings recession, yet projections are for maybe 0.3% decline on a year-over-year basis. So to the degree companies typically beat by about 3%, we could see 2 or 3% year-over-year earnings growth. So that'll be real important, and certainly with some of those big tech names that you mentioned, we'll be focused on those.
And John, what are some of the bellwether stocks that you'll be watching, especially when you try and figure out the state of the economy and the state of the consumer as well?
Yeah, the bellwethers certainly within communication services. We're looking for maybe 30% earnings increase for the group, and then followed by consumer discretionary, call it maybe 20% year-over-year earnings growth. And leaders on those would certainly be Meta Platforms in the communication services, and then, of course, Amazon on the consumer discretionary sector.
And of course, we've been looking at the impact of rising tech stocks sort of lifting all boats for the rally that we've had so far this year. But obviously, market yields having their time as well. But you're saying that it's entering a new era. How so? What does that look like?
Yeah, I think, Rochelle, that investors need to really recognize, that to the degree we avoided recession thus far, the soft landing hopes, we're seeing several dynamics that have me concerned. Energy is outperforming consumer discretionary. So if this was really a soft landing, we would see more, consumer performance, whether it be staples or discretionary. That's one. Secondly, I don't think 10-year yields are rising because of optimism that we avoided recession. I don't think it's a glowing endorsement of future growth. I think rather it's a function of Treasury issuance, which could be up another 20-25% over the course of the next year. As you know, fiscal fourth quarter ending in September, we saw a 30% increase in Treasury issuance. And consequently, I just think without the banks being buyers that they had been conceived previously, without the Federal Reserve having been a buyer, without China and Japan buying to the extent they have previously during QE, I do think that you're going to see upward pressure on yields. Technically, the 10-year could go to 5 or 5.20. And you also have to factor in that in periods where more interest rates are at a more normalized level, if you will, the 10-year typically trades about a 200 basis point premium to the consumer price index. So for all those reasons, I think investors just need to recognize that it is a new era with interest rates, even though we may have avoided recession thus far. And you may have a defensive safe haven bid on the 10-year. In the meanwhile, given Ukraine, given Israel, nonetheless, I do think there will be upward pressure going forward.
And I mean, a lot of people still looking at this inflation picture. We're still getting a lot of Fed speak coming out. Chicago Fed President Austin Goolsbee telling the Financial Times that basically moderating inflation isn't a blip. This is something that's here to stay. This is a trend that he's expecting to continue. What does that mean for how you advise clients who are trying to stay defensive, but also trying to take advantage of the gains as the market's indicating that they think we've perhaps going to skip a recession?
Let's work. Let me tell you, Rochelle, let's work because it's many challenging things coming at us, right? And what we're trying to do as stewards of our clients' assets is to direct them properly. And you have Goolsby's statement. We had Harker last week. So, I believe, given the work that the 10-year yield has done over the past month, think about it. I mean, inflation troughed in July, yet the 10-year Treasury yield is still up 75, 80 basis points since then. So, there's another dynamic going on here. So when advising clients, still want to make sure, the slight overweight value relative to growth within the intermediate fixed income space, still like investment grade. I think it's too early to go longer durations. I still want to be in the intermediate time frame. I do believe the Fed frankly, I believe they're done. But I also disagree with Fed funds futures saying we're going to have 2 cuts in the first half of next year. I think, ideally the way to play this, particularly during election year, they don't want to repeat the mistakes of the Arthur Burns Fed in the late 70s, early 80s. This way, there's a situation where by keeping rates steady in that, say, 5.5% Fed funds rate, as you get a decline in core inflation measures, that enhances the real interest rate, which is a subtle way of keeping credit conditions tight, so we don't have inflation coming back in a series of waves. Because I agree to an extent with what Austin Goolsby has said, but I do believe that the underlying pressures of core inflation will persist longer than the market currently believes.
Indeed, and we've certainly seen that story play out throughout the year. I appreciate you taking the time to join me this morning. John Lynch, Comerica Wealth Management CIO. Thanks so much.
Thank you, Rochelle.